This is Countdown to the Open. I'm Manus Crenny, in for Jonathan Farrow this morning. We're just waiting for the cash trading to start. You had the worst start to the year for across the assets since 1999. Nasdaq was down 1.7% yesterday. You're looking at a pretty brutal moment of reflection. By the way, the flow of money into these equity markets, $19 billion went into these markets through to the close of business on the 27th. For the flow is there. The question is, there is a lack of conviction in this morning's first trades. It's day two of a pretty tortured opening, the worst since 1999. In terms of the rest of the assets, you can see here the debate is whether it's going to be risk or rates that define the trajectory for the dollar. We had Rabobank with me this morning saying that Jane Foley has some sympathy for parity in terms of the euro because that Europe is so challenged at the moment, and the ECB will probably be outcutting the Federal Reserve. 10-year yields pop a little bit higher. The gravitational force, as Katie Greifield questioned last week, is heading towards 4%. What would that do to the technology trade? And crude is still mispricing war premium to the extent of around $12, according to Rapid Energy, even though it bounces by nearly 2% on those rising escalation and threats between Israel and Lebanon. We're waiting for some confirmations there. There are opening trades and timestamps to be had. Apple is on the block, the tech giant extending its decline for a third session after leading the way lower on Tuesday. Ed Ludlow joins me with more. What happened to the $4 trillion valuation that we were told about last week? Ed Ludlow, why oh why the shaking shivers in Apple? Good morning.
Good morning. Well, there's a narrative that's building of the Magnificent Seven we talked about so much in 2023. Apple perhaps is the least magnificent of the lot. We're down another half a percentage point. As you said, a third straight day of declines. It follows Tuesday's session where Apple had a decline of 3.6%, its biggest drop since the end of September. The catalyst being that downgrade from Barclays, a change in price target to $160 a share, just a $1 trim, but moving Apple to underweight. Their thesis is basically that the stock defied gravity in 2023, right? You had several quarters where earnings missed expectations, and yet the stock grows 50% on the year to a record, a $3 trillion market cap. They don't see that lasting. Their analysis is based at looking at the volume and mix of iPhone 15, the latest generation iPhone, having concerns, and then looking ahead to the iPhone 16 and saying, we don't feel there's enough on the technology cycle, technology upgrade perspective to keep driving this stock forward. We care as well because it had an impact on markets, right? This was the biggest drop for Apple since the end of September, but it also pushed the Nasdaq 100 to its biggest one-day drop since the end of October. Biggest points decliner on both the S&P 500 and the Nasdaq 100. So that will be the story for 2024, right? How magnificent will Apple be? Will it defy gravity as it did in 2023? And what will be the catalyst to drive growth? If not iPhone, some other category, be it services or another device.
You know what they say, Ed? Smile on the way up, but I don't think anybody's calling time on Apple just yet. Ed Ludlow there on the Apple moves. We're also keeping an eye on Disney. You got Blackwell's Capital will nominate 3 directors at the entertainment giant to preserve Bob Iger's vision. Abigail Doolittle has the latest on that. Preserve or shake up? That's what goes through my mind. Abby, good day.
Well, good day and good morning. And I think that this overall is a board battle that is intensifying because we, of course, have had Trion's Nelson Peltz in the mix for quite some time. But today we do have 2 firms, ValueAct and Blackwell's, essentially saying that they are going to enter the fray on the side of Disney and Bob Iger, well ahead of the company's annual meeting that typically occurs in March or April. Now, to set the stage again, Nelson Peltz's hedge fund, Trion Partners, they plan to nominate 2 candidates to Disney's board this year. They have a roughly $3 billion stake, intensifying their roughly year-long campaign against Disney for change, saying that the board is too cozy to CEO Bob Iger and that they are disconnected with shareholder interest. Now, this morning, ValueAct saying it will support the Disney board's recommendation. They also have a confidentiality agreement where it sounds as though there could be some information being exchanged there, some advice being provided. Then Blackwell's, as you mentioned, entering the fray, nominating 3 people to the board and vowing to preserve Disney's Iger's vision. Not only that, they're also demanding that Peltz immediately end his campaign for change. What makes all of this interesting, Manus, of course, is the fact that the stock down more than 20% from last year's peak. This is a situation that could could continue to develop ahead of that annual meeting this spring, where shareholders will in fact get to vote, and it's going to be interesting to see who they will be voting on at that time.
Yeah, well, they want a higher stock price, and that involves change. Abby, thank you very much. Abigail Doolittle, sticking with the boardroom, we've got Bloomin' Brands. They're naming 2 directors. It's a new cooperation agreement with Starboard Value. What are the details? Simone Foxman is with me. Simone, what have we got?
Yeah, Manus, I don't know if you've been to these restaurants yet. Outback Steakhouse, Bonefish Grill, that is Bloomin' Brands. These 2 new board members are part of an agreement with Starboard Value. One is from Starboard Value, John Sagel. The other, Dave George, had been the COO of Darden Restaurants. Starboard now owns about 9.7% of the company's common stock. That was originally disclosed back in August. The company also said that it's going to form an operating committee. Those 2 new board members, as well as 2 current board of directors members, to look for ways that it can improve the brand. Starboard Value, really known for its successful proxy fight with Darden Brands. That got a bit combative a couple years ago, back in 2024, and it eventually resulted in Starboard taking full control of the board. So far, we're not seeing that same sort of relationship between Starboard Value and the brand here. In fact, Jeff Smith, the CEO of Starboard Value, saying that Bloomin' Brands had been collaborative and open dialogue so far. But this news causing Raymond James to raise its price target to $30 a share. The company's shares are already up 39% since last year. They were up 39% last year, I should say. They were up roughly 10% since Starboard Value announced was reported to have taken its stake back in August, but they're still about 10% below hitting their April 2021 high, and we're seeing a little bit of a pop this morning, Manus.
Yeah, the thought that goes through the mind is where they're going to trim the fat on the steak on that, excuse the pun. I like the look of Fleming's. Looks very, very regal, very reminiscent of a British eatery. And Bonefish Grill, I'm all in on that. Simone, thank you very much. Simone Foxman with the very latest in the boardroom battle. Let's turn our attention to crypto. Coinbase leads the sector lower. Speculation, I get this. Spot Bitcoin approval. There you go. Katie Greifeld. I mean, this has got a bit of a shakedown. ETS, we were talking about them last week. What happened? What's gone wrong? Why?
Well, right now you're watching Coinbase, Marathon, Riot, all taking a bath right now alongside a plunge in Bitcoin. That plunge as much as 9% this morning, briefly breaking below $41,000 per coin. And as you mentioned, Manus, speculation around a potential spot U.S. Bitcoin ETF finally launching. It's at a fever pitch right now. So to set the stage here, the SEC has a deadline coming up next week to take action on one of the dozen or so applications in their queue right now. And the current thinking is that they'll either approve or reject all the applicants at once rather than playing kingmaker here. So as you would expect, rumor, innuendo, it's at an all-time high right now. That's translating into volatility, both in Bitcoin itself and those crypto-related stocks. But it's important to note that all of these assets, all of these names, they're coming off a banner 2023. Take a look at Coinbase. It surged nearly 400% last year alone. So what you're seeing could be as simple as people selling the rumors, selling the news, choosing to take profits here rather than waiting around.
Okay, Katie, let's keep an eye on that. The ever-giving story of the ETF. Patrick Frizzetti is with Rose Advisors. He's weighing in on the new year. This is what he says. The market appears overly optimistic, as I do not think we are out of the woods on inflation. The genie is not going back in the bottle without a cost. Patrick joins me now. I'm focused on the cost, which implies higher for longer or the Fed is not done. Good morning. Be the contrarian for once.
Yeah, I'll be a contrarian. I think 2023 was a year well explained by, first it started out with a banking crisis. The Magnificent Seven outperformed until rates peaked, right? Rates peaked in late October. Then you started to see the equal-weighted S&P stocks outperform those tech stocks. And I think, when you think about as, lower rates and the Fed lowering rates started to price into the market, there's 2 expectations. Two things really, justify lower bond yields. And that is inflation's going back to 2% or something else worse is happening, like we're going into recession. And I think it's very unlikely that inflation gets back to 2% anytime soon.
Well, that's going to take some kind of a spike in unemployment to really contain the last mile, the last leg, the last 1%. You say that this is an opportunity for equities to rebalance. This is an opportunity for me to rebalance. So where do I rebalance out and into?
Yeah. Look, I look back to the prior year, 2022. You look at what helped, what was defensive in 2022 when the market was down a lot, and then what underperformed in 23. Look at things like energy. Look at materials. Even the healthcare sector overall. I mean, think about pharmaceuticals in an election year. Pharmaceuticals won't be on the hit list in an election year, which it typically is. And I think I look to those sectors to potentially outperform this year.
You're not convinced, by the way, that the money market funds flow as munificently as other people think. I've already had people kick back against that this morning. Why do you think the money sticks in money market funds for longer than we presume? That's what I'm thinking, which is why would I give up 5.3% to take equity risk if there's already a shakedown at the moment?
Yeah, you won't. You won't. I mean, if you were giving up all those gains and you weren't chasing the momentum of 2023 and you were sticking with 5.5%, 5.25% money market funds, you're not going to go into, these high priced or, high multiple stocks right now. It's not going to become a risk on trade. I think they'll stay where they are, or maybe they move some of the money into bonds or extend some duration or something along those lines. But I can't see adding on significant risk if they've been sitting out much of the momentum in 23.
Okay, well, maybe it just takes a chunky cut from the Fed in the first instance rather than that sort of slow drift of 25 bips at a time to shift the money out of money market funds. Patrick, stay with me. Patrick Fruzetti, my guest on the markets. Coming up, Mike Mayo doubles down on the bullish call for Citigroup.
I understand Citigroup's mistakes, but what's different this time is the result of this restructuring should be a much more simple Citigroup, not a more complex Citigroup, and that's night and day.
The recent rally in banks sending JP Morgan to fresh record highs. Where are they winning? We'll break down the financials. That's next, right here on Bloomberg.
My top three picks for 2024 are Citigroup, Citigroup, and Citigroup. I think the bottom line is that Citigroup is becoming a much more simple and profitable firm whose earnings should double over the next 3 years. But this is make or break time for Jane Fraser. You said, is this due to Jane Fraser? Maybe. I think so.
Yeah.
But not definitely. I understand Citigroup's mistakes, but what's different this time is the result of this restructuring should be a much more simple Citigroup, not a more complex Citigroup, and that's night and day.
Wells Fargo, Mike Mayo, doubling down on his bullish call on Citigroup, but not necessarily on Jane Fraser. Now, the bank superseded JP Morgan as his top-rated big bank stock for 2024. The analysts expecting shares to more than double over the next 3 years. Alison Williams joins me now from Princeton. Alison, good to have you with us. It's an interesting nuance, isn't it? I'm bidding up Citi. I'm putting them up on the stack. But I'm not convinced it's all to do with Jane Fraser. But this entire restructuring, I'm understanding, is Jane Fraser.
I think Jane Fraser is the difference this time. I think for an investor to buy Citigroup, they have to believe that this is the time the restructuring works. And let's be clear, the valuation of Citigroup, it's traded at a discount to book for a long period of time, and I think that reflects doubt. This is a stock that, for decades, many investors, many sell-side analysts have said, look, there's a lot of opportunity here. This is a company with a lot of great businesses. If they can just, improve their efficiency, get their act together, shed some unprofitable businesses, it should be a great stock. Unfortunately, many of those calls have been disappointed, and so it's been many, many years of trying to reach a target and not being able to reach that target. So the medium target for Citigroup now is 11 to 12%. The cost ratio to get there is something that they're still way far away from, and so the question is, can they get it done? Jane Fraser has made some tough decisions, exiting businesses that the bank has been committed to forever. Yeah. And I think two things. One is Jane Fraser, but two is, I think one of the best things that's happened to Citigroup is the regulatory scrutiny that has forced a lot of the transformation and has forced them to improve their risk systems, forced them to do a lot of the spending that perhaps they should have done decades ago to bring together all the disparate businesses that were purchased and brought together under one umbrella, and not necessarily integrated in an efficient way.
Well, that takes us back to November when Jane Fraser shuttered a business. They were so committed to the Muni business. It was like inextricably linked. Alison, thank you very much on the banks. Let's turn our attention to JP Morgan, soaring to record highs for the first time in over 2 years. Though CEO Jamie Dimon has warned the bank is over-earning in some areas. What does he mean by that? Abby?
Well, their tremendous profit last year, they just did a tremendous performance. And what's so interesting here, Manus, is that, of course, JP Morgan is considered to be the best in class, in large part because of CEO Jamie Dimon. Now, the stock may be down just a little bit today, but yesterday, to your point, they did put in a record high, the first one in more than 4 years. And if we take a look at JP Morgan last year, that over-earning that you were just talking about, referenced by CEO Jamie Dimon, the stock up 27%, the best year since 2019. This as the KBW Bank Index, or the benchmark, down 5%. So some clear outperformance. Investors flocking to Jamie Dimon's best-in-class, largest bank in the wake of the collapse of those regional banks in early 2023. Plus, they benefited from the acquisition of failed bank First Republic from FDIC. In fact, we had a clip earlier of Mike Mayo, Wells Fargo analyst. I'm not sure if this was from yesterday, but he did say of JP Morgan, Goliath is really, really winning.
There you go. You haven't got a JP or an M in it. You're not in it. Abigail Doolittle there. Let's turn back to my guest, Patrick Rossetti. Patrick, would you be long banks? Is there anything that can convince you to be long a bank in the United States of America?
Not, not at the moment, to be quite honest with you.
Why?
Because look, we're what 10 months out of a banking crisis, and we still haven't seen, I think, the worst of the commercial loan issues and defaults. We don't know where the bodies are buried, so to speak, and you have these large bank balance sheets there. You were talking about Citigroup, and this is what the big banks do. They restructure, every once in a while, then they try to get back on track. And, I think the commercial loan issues that banks are going to have to face, could create a lot of problems. There was a new Fed paper out that basically did some sensitivity analysis and talked about, just a 10% move down, what that would mean to Tier 1 capital. And if you see a 20% move down, you'll see a big impact to Tier 1 capital of the large banks. And that's the thing why I think there's just better things to buy out there, and I've avoided the banking sector. It's not to say I've always hated banks. It's just to say at the current moment, given what could potentially be, I think, a crisis, and many have thought it. They've just been waiting it out. Well, when is the cliff going to come? When is the cliff going to come? And I think it's eventually, until I have some more information on that, on that data, it's very hard for me to invest in banks.
No, listen, I know once bitten, twice shy on some of on some of these banks, and certainly last March, nobody saw that truck coming to roll over the top of us. In terms of 2024, do you want to be? I know that you want to be longer, slightly more defensive plays, but is that something slightly more, dare I say it, boring? I mean, if I said Novo Nordisk was going to be a boring stock in Europe, you probably laugh at me. But here we are. Pharma is very much a big play, isn't it, in terms of the weight loss drugs and in terms of cancer treatments? Where do you want to be, if not in financial?
Yeah, I mean, I like healthcare. I like the pharmaceutical space. I really like materials. I mean, if we're going to have a weaker dollar, I mean, if rates are going to go down, if the Fed is going to cut, which I'm not a believer that they're going to, the market may be pricing in too many cuts, I think, at the moment. But if the dollar's weaker, you want to own materials, you want to own energy. And like I said earlier, this might be the first election year where pharmaceuticals are not, at the top of the hit list for, one of the political parties.
You mentioned election very briefly, literally in 30 seconds. Do you think this market will back up and front run that election in 30 seconds? Do you think we'll see real action in September and then quiet?
It really depends how close the race is. If the race is close, you can see that, and then post-election, the market tends to rally because markets don't like uncertainty, and then when they get, they find out who the victor is, assuming we do, the market tends to rally into the end of the year. Simply.
That's why we pay commission to people like you. You're supposed to be smarter than us and have the answers to that. Patrick, I'll leave you with that nervous twitch for the rest of 2024. Patrick Frizzetti. Coming up on the show, market moving events that you need to keep an eye out for your trading diary. We'll break them down for you from manufacturing to jobs right here on The Open. This is Bloomberg. Time now for your trading diary in terms of what we're watching. By the way, all that argument about a Brexit market, yeah, that's history. Down 1.5% on the Russell there. You're also seeing the rest of the markets take a little bit of a breather ahead of some of the data that we've got. The ISM manufacturing numbers and the JOLTS data, they will hit the tape at the top of the hour, so just under 4 minutes away. Following that, it really is the nuances of the minutes. Will they confirm and validate the Powell pivot? That is at 2 p.m. Eastern Time. Thursday, you got the jobless claims. That is the curtain raiser to the main event. You thought you had Christmas Day and Thanksgiving. No, it is the jobs report for December. Let's see what the payrolls number give us. That is pretty important. Okay, stocks and bonds are having the worst start to the year since 1999. Where were you in 1999? Countdown to the open for this morning.
Experts, great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Minutes into the U.S. trading day. It's Wednesday, January 3rd. Here are the top market stories we're following for you at this hour. Bulls take a breather. Stocks drop and yields climb after a banner end to 2023, with investors rethinking some of the more aggressive Fed rate cut pricing. Red Sea detours. Shipping companies get a boost after Goldman Sachs upgrades Maersk as spot rates rise. And exit interview. Morgan Stanley Executive Chairman James Gorman joins Bloomberg's Sonali Basak in an exclusive interview as he leaves his post as CEO. From New York, I'm Katie Greifeld with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets, Guy. I'm thrilled to be here.
It's great to have you here, Katie, and we've got a lot to talk about. Boy, we've got a lot to talk about. There's a lot of data breaking right now. We're looking forward to the Fed minutes a little bit later on. ISM manufacturing, you want to pay attention to this. The headline number comes in ahead of expectations and above last time. Prices paid, though, is soft, which is interesting. Employment looks strong. Jolts dip a little bit as well, certainly below expectations. Katie, everybody's trying to figure out what's going to happen next. Does this data really change the narrative?
Luckily, I don't have to answer that question, and there are a lot of numbers to sort through here. Luckily, sitting to my left, we have Bloomberg's Mike McKee joining us now to break down some of the numbers. What's the takeaway here, Mike?
I think the takeaway is your good luck for the U.S. economy here, because we do have some good numbers that continue the narrative that the Fed may be able to start cutting rates in the first half of the year. Let's start with jolts. There's less news there than in the ISM. It does fall to 8,790,000 from 8,852,000. So the number of job openings falls, not a lot, but falls a little bit. The quits rate does stay about the same at 2.2%. So the number of people who have thought they could get a new job by leaving their current job seems to be about the same. No real change in the labor market in these numbers. Of course, these are November numbers. Now to ISM, as Guy mentioned, we get 47.4, which is above the forecast and above the number we had in the month of November, 46.7. So some movement towards expansion. And then the three indicators that people really look at underneath the headline there, prices paid, as Guy mentioned, 45.2, down from 49.9. That 49.9 worried people last month, but it looks like it's retreated a little bit. Tim Fiore will be along in just a minute, and he can explain what's happening there. New orders at 47.1 do fall a little bit from 48.3. So I'll throw out a question to Tim when we get to him. Basically, he said we were sort of at bottom and starting to go back up last time. Is that still the case? And then employment, this is what will matter for Friday. People incorporate this into their numbers, their forecast, 48.1 from 45.8. So in almost everything except new orders today, the numbers we've gotten at the top of the hour just continue the narrative that the economy is slowly getting better.
Well, let's bring in the man of the hour. Mike, thank you very much indeed. Normally that's you, but in this case it's Tim Fiore, who is the chair of the ISM Manufacturing Business Survey Committee. And he's here for some instant analysis. Tim, great to see you as ever. Happy New Year. Tell me what I need to read into these numbers. What is the instant analysis?
Okay, so first off, we collected this survey. Pretty much most of the information was coming in before the Fed signaled that things were going to be improving in 2024. So keep that in mind. You know, with that being said, we have been saying that we're in the trough, and I think we're still in the trough. We have the major sub-indexes adjusting slightly to get ready for future improvement. For instance, although the new order number did come down, there was enough new orders and stable production output to slow the rate of backlog decline, which is really good. We're finally seeing that backlog get up to 45 plus. Customer inventories improved, new export orders improved. So, you know, given the signaling that's happening here, I would expect that demand is going to improve in the first quarter for sure. On the production side, the revenue side, we were essentially flat month to month. So that's still consistent with where we've been for the last 4 or 5 months. So the billings are still strong. And then on top of that, the employment number did come down, which I think is very positive. And we still have a 1-to-1 hire to force manage ratio in the month of December, with a lot of that being, over half of that being layoff use. So companies took more drastic action in December to get that head count down to get ready for January. And on the input side, we're pretty stable. Inventory is still extremely low. We'll see what happens now as we go into this year, and we're out of last year and the liquidity issues and the closing of the year. So overall, we ended up with a really good month in December, you know, especially assuming that none of our panelists had the benefit of, you know, 3 rate cuts coming in 2024.
And you take a look at market reaction right now. Stocks holding their losses, but the bond market yields dropping ever so slightly here. Let's talk a little bit more about the prices paid component, because as Mike McKee mentioned, when we got up to 49.9 in the prior reading, there was a little bit of nervousness. Of course, this reading coming in at 45.2, so quite a drop there. How are you thinking about that?
Well, the problem with the prices index is that if we watch it month to month, it keeps going up and down, up and down. So I went back and I did a 4-month average on it, and I think we're coming in at somewhere around 47, 46, 47, which is pretty good. It says consistent price decreases. Now, for the month of December, we had an energy market decline, which really helped. But it was offset by steel price increases as well as aluminum, and to some extent, plastic starting to go back up. So I don't really see prices coming down much more in the short term here. We closed 2023 with a 4.1% price growth throughout the year, and our panelists are predicting another 3.1% price growth in 2024, which is a really interesting number. But I'm not expecting that price number to drop much more. I mean, staying at the 40, at the 48.5 that it came in, that's a lot lower than I thought.
Okay, Tim, let's think about how the Fed will therefore read this. A lot of the disinflation that we've been seeing recently has come from the goods side of the equation rather than services. Is that disinflation process that we've been through now done? That sounds like is what you're saying.
I felt that way for several months here, because what's happening with the number, when you're seeing it drop, it's really driven by the energy markets. And that's transitory. It goes up and goes down. So, I've been watching the fundamentals, really the plastic, steel, cement, and those prices are still pretty strong. But people are engaging. They're accepting them as the current price structure and moving forward. So I think, I was watching the show yesterday, and, what are the risks for 2024? It's really the return of a higher inflation rate, I think, that's the most concerning at this point.
Definitely top of mind for plenty of investors out there, too, the path of inflation, whether we could get another tick higher. But talk to us a little bit about inventories. Of course, we're coming out of the retail reporting season. Inventories, a hot topic there. What does that look like on the producer side of things?
So as we close the year, we do a sales inventory ratio calculation, and we're entering this year with a number lower than we've had in the last 3 or 4 years. So I think the inventory issue on manufacturing is pretty much behind us. But what you're really seeing with that low manufacturing inventory number is an acute awareness to watch liquidity, especially as we close the year. That had to be one of the primary criteria for performance in 2023, producing cash. And consistent for many, many months now, we've had a very low manufacturing inventory number. But I think given the signaling that we got in mid-December, I expect that inventory number to get back above 50 before we get to March.
Tim, just to wrap things up, we're going to get Fed minutes later on. Big focus on how many rate cuts we're going to get in 2024. What would 3 rate cuts mean to the manufacturing side of the economy? What would 6 rate cuts mean to the manufacturing side of the economy? Do you think this is a side of the economy that needs significant rate cuts?
Well, we spent a lot of money last year, as it turned out, in CapEx. We did, I think it was 14% over 2022, which is a huge number. And we're forecasting another 12% in 2024. So our panelists are really saying, hey, we're ready to invest. The question becomes, when do we pull the trigger? And I think in mid-December, we got the signal that it's probably okay to pull many of those triggers. So, and I think because of that, we're going to see the new order level come up in the short term here. Probably by February, we'll see that. I mean, things don't happen on a dime except when the pandemic hits. But I would expect that the rate cuts are going to be very positive to this. Like I said, I think the single biggest issue, at least for the first 6 months, maybe 9 months, is what does that do to the price structure of inbound materials? And then how does that translate to carry through to pass through? So, I think the rate cuts are very positive. I think it's going to be a real momentum tailwind for the manufacturing community. Without the rate cuts, we were projecting a 5+% revenue growth in 2024. So that's a combination probably of additional pass-through as well as just organic growth. So, 2024 is really lining up well. I think the December PMI number was a good way to end the year. We're still in the trough. We came up a little bit higher than we did in the month of November. But I think there's a lot of tailwind here for us to drive forward. And as I said, I think the biggest issue here is what's going to happen to the input costs, and does that cause the Fed to be a little bit more concerned and maybe back off a little bit?
All right, Tim, really appreciate your time. Great to check in with you. That is Tim Fiore. He is the chair of the ISM Manufacturing Business Survey Committee. Now coming up, we'll get insight to our question of the day. Did the Santa rally steal 2024's gifts? How nefarious. Callie Cox, U.S. investment analyst at eToro, joins us next. This is Bloomberg.
It feels like we're coming into the new year and now, of course, and we're already seeing a very the start of a reset, perhaps.
Starting off 2024 with a little bit of a breather.
We're just pausing for breath.
Investors start to take really a sober second look at what the economic environment is going to look like in the year ahead.
We had a very strong rally in the third quarter of last year.
Equity markets have rallied 16% from the low point in October.
Given the rally we've had,
it's an understandable, rational question to be posing at the beginning of the year. Was it overdone?
It's just a really great time to play a little bit of defense.
I don't think that you can have the kind of growth that we've had given the kind of economic backdrop that we're looking at.
The Fed is probably going to be disappointing here relative to the speed at which rate cuts are priced into the market.
We've got some key US data coming up this week.
We will look for confirmation of the inflation and economic data in the next few weeks.
And those are just some of our Bloomberg TV guests earlier weighing in on markets in the new year. And that brings us to our question of the day. Did the Santa rally steal 2024's gifts? Callie Cox from the U.S. investment analyst over at eToro joins us now. And Callie, needless to say, it's been a pretty soggy start to the new year. And you think about all the exuberance in the last few months of 2023. Did that mean it was inevitable that we were going to see this downward draft at the start of 2024?
Well, nothing in markets is ever inevitable, Katie. I'm not surprised that we're seeing a heat check in the stock market right now. After all, the S&P hasn't pulled back more than 1.5% from a month high since, I believe, the beginning of November. That's a long time to go without some kind of breather.
Okay, Callie, good morning. It's Guy. We're going to get a breather. Everybody seems to believe that we're going to get a breather. My question is, do you buy the breather? Do you buy the dip? If we get a dip, does the long-term story remain positive, and therefore that is something you want to step in on?
Well, we think you should. And going back to the question of the day, we do think that there are gifts left under the tree. Of course, you have to think about markets a little bit differently this year for good reasons, too. I mean, we just saw an ISM manufacturing number that shows us that one of the most downtrodden sectors in the economy is coming back to life. So, we see a lot of value in rate-sensitive cyclicals at the moment. Even though a recession is still a big risk, we're still not sure what breaks underneath the surface. So you have to be careful here, but I don't think this is a rally or this is a market that you can really sit out.
And it's interesting to hear you say that because just this morning we heard from Richmond Fed President Tom Barkin saying that a soft landing for the U.S. economy, it's looking more likely, but it's not certain at this point. And it's not certain that the next move necessarily will be a rate cut from the Fed. And you think about all the data that we're sorting through, the ISM figures in particular that we got this morning. How are you thinking about this Federal Reserve and the possibility of 3 to 6 rate cuts?
Right. Well, if you think about where the Fed is sitting here, I mean, you just mentioned what a Fed president said. I'm not sure I can say it any better than him. But, from what we've seen in economic data, from what we've heard from the Fed, it seems like celebratory rate cuts are in store, unless, of course, we see a breakdown in the job market. Now, the question for markets is, what does that mean? How big are these rate cuts going to be? How steep will they be? And if you think about the rate of neutral, that's the big question out there. The Fed probably has an argument to get rates down to neutral. That may mean a few cuts, but 5, 6 may be a little dramatic. I think that's the biggest question investors need to answer.
Yep. Callie, just going back to the ISM, Tim Fiore on the show just a few moments ago talking about the fact that maybe one of the biggest risks out there is actually that the economy does better, that you get a real tailwind behind manufacturing, that the disinflation that goods have given us over the last 12 months dissipates, and that we see an upside acceleration on inflation. If you get that kind of scenario, can the Fed cut at all? And what happens to markets if the Fed can't cut? The consensus seems to be at the moment that we get a soft landing. What happens if we get no landing?
That's a good question. And hey, I'm not complaining if we see the economy pick up again. Given everything that we've been through, I think it's pretty miraculous that we're still staring at an economy that is so resilient. If we see inflation pick back up, I can't imagine it gets to the point that we saw in the middle of 2022. I think inflation has, a bit of a lid on it right now, especially because there's so much pressure on the economy. And if we see the economy pick back up, it could be in those more rate-sensitive sectors, maybe on the goods side, as you mentioned, Guy. So I think that there's going to be a bit of a counterbalance there if we see it. Of course, the market is priced in rate cuts. So the Fed coming out and saying, maybe we're getting a little too far ahead of ourselves could bring back some of that exuberance in the rally. But, my biggest worry right now is a recession, and any signs outside of a recession, I think, speak to a market that's worth being bought.
And Kelly, it's interesting. So far, our conversation has been very Fed-focused. It's been very macro-focused. And you think over the course of 2023, it feels like every market's conversation started there with the macro. Is that the conversation that we're going to be having in 2024? Is this still a very much Fed-driven market?
Macro is always important, but I actually think the style of investing is what you need to be focused on right now. We saw in 2023, big tech powered the market. The S&P was up 24%, yet 70% of S&P stocks underperformed the index last year. That's a huge bit of dispersion that you have to consider. So there are a lot of stocks that haven't participated in this bull market, and if the economy stays strong, we could see those stocks start to participate. They lean on the value side, though. We've seen a lot of acceleration a bigger rally in growth than we have seen in value, and now we're starting to see that value come back.
Kelly, the earnings season is going to kick off in a couple of weeks as well. We've seen a lot of multiple expansion. Are we going to see profit expansion to justify to fill that gap? How critical is that going to be in 2024 to keep the rally on track?
I think it's very critical. Earnings, of course, are, the heartbeat of corporate America and the heartbeat of the stocks that end up making up this market. Luckily, Wall Street sees another year or a year of profit growth. It's not the kind of profit growth you want to see because it's mainly due to cost cutting and lower costs. But at this point, I'm not sure there's a lot to complain about. I think the earnings trough is behind us, and that could be a supportive area for investors, especially if they want to buy into those, harder hit sectors in the market, especially on the value side.
Callie, great to catch up. Happy New Year. Thanks for joining us. Callie Cox, US investment analyst, joining us from eToro. What are we going to talk about next? We are going to get company specific. We're going to talk Disney. Disney CEO Bob Iger lining up allies as he tries to stave off pressure from the billionaire activist Nelson Peltz. We're going to have the latest in the battle over board seats at Disney. That is next. The startup is coming. This is Bloomberg.
It's 20 past 7 on the West Coast, so let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. And Ed, let's talk about Disney and what Bob Iger is doing here. It seems like a pretty good morning.
Yeah, so Bob Iger now has the support of Value Act, an activist investor, and Blackwell's, a very small activist hedge fund. And in quick succession, one very sizable firm with an unknown but sizable stake in Disney, Value Act, and a very small firm with a small stake in Disney, Blackwell's, have basically bolstered him in his long-running dispute or activist battle with Nelson Peltz and Trian. And each party kind of wants a different thing, but it does kind of count as a PR win for Bob Iger, who, as you guys know, he's been under pressure since he returned as Disney's CEO in 2022 at the back end of that year to try and get the company back on track. And Nelson Peltz's position is succession plan was a disaster, he doesn't like the strategy, and he thinks executives are paid too much. So the net result is, can these two activists in support of Iger help him put together a board that appeases everyone?
What are the chances of success here? What does Peltz think in terms of the latest developments? This I would assume he would read as being hostile to his view.
Right, well that's why I say everyone wants something slightly different. So Disney has its board nominations, Gorman being one of them, right, former Morgan Stanley CEO. Blackwell's, very tiny, very small, has put forward 3 completely separate board nominees, different to those that Disney had proposed. Iger said that he'll kind of look at them. And then I go to the size and scope. You know, in an activist battle, does having the most shares automatically mean you win? We know that Trian and Nelson Peltz has about a $3 billion stake in Disney. The size of Value Act is unknown, although Bloomberg's reporting suggests that it is getting increasingly larger. Is it enough to appease shareholders outside of those 3 if a compromise is reached between the 3 of them? The stock's flat, right? I think we're Down. No, we're completely flat on Disney. So the market reaction tells you that it's a stalemate, I guess.
Yeah, the market, if you think the market's always right, apparently this is just a lot of a stalemate, as you say. But what should we be watching next? Of course, we've been in this battle for quite a long time now. What are the next points on this timeline?
Yeah, I think it's the idea that when the shareholders meet for their AGM and vote, if the board composition can be reached, at the same time, Iger's going about his business right, which is targeting $7.5 billion in savings, and like everyone else in that world, trying to work out the formula for profitable streaming, a combination of subscription and ad-supported tiers while you pull back on the spending on content. Without content, you can't bring in new eyeballs, and it's proving to be tricky for everyone. I think that's still going to be a story in 2024, who cracks the streaming profitability issue.
In terms of where Disney is placed in that, it's got quite a lot of good content, seems to have a reasonably successful strategy, but others are merging, others are potentially getting